So on this channel, I've spoke before about why banks hate crypto and how there's a little bit of a head-to-head competition there. Well, we call it competition. That's not really the right way to say. In this video, we're going to talk about where your money is safe. Is it more safe with the banks or is it more safe with crypto? This is going to be a debate that is going to be increasingly on the lips of all entrepreneurs and money movers around the world, as it already is. Now on this channel, I made a video before about why traditional banks hate crypto. They hate your crypto businesses, they hate your crypto savings, they hate everything about it, and it's evident why. And they're trying to catch up. There's a lot of theory and speculation about where this is going to go, whether the countries are going to create their own kind of digital coin or something like this. Now, although that can be really good for quick payments across commerce and many different things with banking, the problem is it is not going to have the same level of sovereignty and freedom that crypto has, right? With crypto, it doesn't matter who you are, what you do, your crypto account is not going to get shut down. If the bank create their own type of digital currency, you are still at risk of being shut down, being blacklisted within a second. So let's go. Now, first of all, banks are safe. They are always going to be safe. There's always going to be a place for banks across the world. With all crypto, it doesn't mean that banks are going to disappear. It means they're probably going to go into crypto. Now, if you look what happened with the Roman Empire and even the British Empire, now they didn't really disappear. They turned into something else. And my idea is that the banks are going to somehow try to turn into crypto. They're going to try to get a monopoly over it one way or another. Within 20, 30 years, we might be saying, oh, what happened to all the banks? Well, the banks might just turn into crypto. Anyway, let's get on with the video. So, if you woke up to a bank freezing or an exchange hack tomorrow, and you had $1 million or pounds or whatever, where would it be safer to put it and why? So in this context, what does safety actually mean? You want a counterparty risk. Who can get default or get hacked? Let's say a bank's exchanges or wallet providers failing you. 2, market risk. Price volatility affecting your purchasing power and your wealth. 3, legal protection. Deposit insurance, investor rights, regulatory safeguards. 4, operational risk. Custody, management, key loss, technical failures and errors on the user side. 5, access risk. The account freezes, capital controls and restrictions on fund movement. Safety is defined by minimizing risk. Looking at traditional banks, where are the protection and limits? So, for a global deposit insurance coverage, this means how much you're covered in case the bank fails, how much they can cover you for it. For example, if your bank fails for whatever reason, a technical error or whatever else, in the US, you get a coverage limit of $250,000 per depositor, per bank, per ownership. The regulator is the FDIC. In the United Kingdom, not a lot, unfortunately, but £85,000 in pounds. European Union, about $100,000 in euros, which is about the same as the pounds. Switzerland, $100,000, which I think is similar to the European and pound. Hong Kong, $800,000, again pretty similar. Singaporean dollars, 100,000, which is not as much as you would expect for Singapore. But again, Singapore have probably such strong banking systems that it's not going to happen anyway. Post the 2028 bail-in rules in the EU and UK, this means that large uninsured creditors bear losses in bank failures, not taxpayers. So the insurance still pays within the limit. Now crypto, where does the safety come from with crypto? Now first of all, the blockchain is an excellent technology. This is what the banks are trying to copy or learn from. Now self-custody, this removes any exchange counter risk and it also adds extra operational risk, that equals your total loss. And for the exchange custody, the risk is more the counterparty failure and hacks. Protection comes from licensing, segregation and audits. On a personal level, as I know many people who use crypto, myself included, crypto is pretty much untraceable. The blockchain is open and fair. It takes seconds to send crypto anywhere around the world. When I went to Georgia, the country, I was surprised to see crypto ATMs. So it's clearly growing, it only just started to be adopted by mainstream, only just. You can absolutely bet your last dollar that it's going to stay around, it's going to get more important. And we might even see small societies or cities built around crypto in the future. So let's look at some of the latest regulation status for the global crypto. In the EU, we have the MiCA rules. Now, this is where it gets awkward, because some of these countries are making it very hard to work with crypto in any meaningful way. For example, the FCA in the UK, pretty much just strict, very strict, right? There's not much more to say about it. This is why many entrepreneurs are leaving the UK. It's not attractive. I really hope they change because it's my country. Now, in the EU, like I just mentioned, they are still going over some rules. So, what it is today might not be exactly what it is come 2026. Dubai have the VARA established a few years ago. Now, this is a comprehensive rulebook that covers all of the licensing, the marketing, and many other activities. Basically, anything about crypto, you go through the VARA in Dubai. Singapore, this is managed by the MAS. It's becoming more strong. It has segregation and custody requirements from 2024/2025. 2025 stablecoin bill establishes an issuer regime. Now they are expanding. Again, a real big note to take on all of this is that countries like the UK are currently failing with the crypto adoption. They're making it more hard. They're making it just impossible to kind of work. Think about this. Think about if you're a young businessman or just any businessman and you're doing work with crypto. You know that all it takes for you to go to another country is a plane ticket and a little bit of a process, right? Why should you put all of your efforts into a country that are going to tax you to oblivion and make it hard for you to move money with crypto? Now, other countries are already clocking onto this and they're going to grow a lot, because you're going to see countries attracting investors, businessmen, entrepreneurs globally. What's it going to do? It's going to bring millions into the country, millions. It's going to create wealth, it's going to create jobs. So yeah, this is why we're seeing the countries like the UK fall, and I'm going to make another video on that soon. And here we go. Because Switzerland, very good for banking, right? And with crypto, they will classify it similar to banks and security firms. Now, El Salvador, very interesting. In 2025, they made reforms that made Bitcoin acceptance voluntarily and scaled back state involvement. For example, the president of El Salvador, a really interesting, cool guy, posts on Twitter nearly every week or every month his crypto portfolio, nearly up $1 billion. And look, as I just said, IRS and HMRC, the UK and USA, they treat crypto as, property. They want to tax you. And what is this going to do? Well, why should I get taxed on it if I go on a plane for 3 hours and I won't get taxed? So the $1 million question is, what is safer? Now, there isn't just one safe bucket. There's layers, right? And there's not just one or two ways to do this. There's different strategies. Let's go over some. Starting with a bank-heavy strategy. Now, this is low volatility, quite safe, quite generalized, although you are at mercy of the banks. The goal here is to preserve nominal value with maximum insurance protection. And this is a lot better for risk-averse investors. Now, strategy B, this is the crypto savvy. Banks 30% of your wealth, self-custody, crypto within your own name, and then exchange 10%. Self-custody 60%, so you're keeping 60% of your crypto. The goal here is sovereignty with strict custody discipline. Multi-sig MPC with geographic key distribution, small portion on licensed exchanges for liquidity, written recovery procedures are essential. Now, strategy C, blended resilience is recommended. Banks 60%, self-custody 30%, 10% for exchanges. Now, the balance here is safety, growth, and accessibility. If you have 50 to 70% across insured banks, multi-bank or multi-country, 20 to 40% in blue chip crypto, the main cryptos, Bitcoin, ETH, 5 to 10% exchange float on licensed platform. Why this is the best is because it gives you the best of both worlds. Pretty simply, you still have strong relations with a bank. You know that 60% is locked in, absolutely safe. And you also know that nearly 50% is sovereign to you without them clashing over. Yes, now traditional banks, the pros, lower market risk, insurance up to the limits, regulatory stability. Now, what are the cons? You have bail-in exposure, that when it goes above the limits, access control and inflation risk. Now let's go for crypto self-custody. What are the pros? No counterparty risk. You have your full sovereignty. You have potential upside. What are the cons? High operational risk, market volatility, technical complexity. So let's look at this country by country, depending on what country you're in. United States, you're still better with banks because, they look at crypto as just taxed and more regulation. Pretty similar with the UK. European Union, again, is similar, but they're showing signs of being a little bit more lenient towards crypto. Switzerland, they treat your crypto property. They treat your crypto properly, right? But still, if you're in Switzerland, standard of banks among the world, so why not do that? Hong Kong, they are looking for a new stablecoin regime, so I'd say about 50-50. Singapore are tightening custody and segregation, but they are known for great banks as well and great operations. You can do both. Dubai, no federal deposit insurance. They have comprehensive rule books for crypto, but it works well, and that's why they attract many crypto investors. El Salvador, they have a traditional banking system and Bitcoin is voluntary, with more reforms coming. How this might look for the future. So let's think about this. Banks adopting more tokenized rails. This is going to mean that traditional institutions are integrating blockchain technology. This is what I'm saying. You can expect this to be increasing everywhere. Regulated stablecoins such as the EU, Hong Kong, they are leading on comprehensive frameworks to get this done. Enhanced segregation standards. More custody protections for exchange users. Protection gap narrowing, but no deposit insurance equivalent for crypto yet. Final recommendations. Don't just choose one bucket. Design layers that suit you, your lifestyle, your business, and your sovereignty. Insured bank coverage. Disciplined self-custody crypto. Licensed exchanges for your liquidity and quick operational needs. So for the short answer, what is safer? For insured limits, banks. Beyond that, for sovereignty and a layered approach going into the future, having a mix without maxing out any single bucket.